Okay, some questions from the market outlook from Sunday. Can you show us an IBKR how to get the 13, 26, and 52 week percentiles on implied volatility? So open up Options Trader and you'll have a screen. In the top corner here, there'll be a little gear icon. Click on that, a little menu will pop down. Click on Settings and you'll get this menu that pops open. Let me just see if I can increase the size of this so you've got it. And it looks complicated, right? But over here under Option Trader, click on Quote Panel. Let me get a better color there for this screen. Click on Quote Panel and your screen will look like this. In the far column over here, find the menu item that has options. Click on that. It will open up. You can see here there is 13-week IV percentile, there is 26-week, and there is 52-week. Highlight what you want and click the Add button and it will show up over here. Go back over here, highlight the one you want, click the Add button, and it will show up over here. Once you're done, you got to click Apply. You can't just close. You got to click Apply, and then you can close that button, and it will show up in your Options Trader. Your Options Trader will look like this. All your options change are down here, and you have a bunch of lines up here. It'll show up on the Quote Panel line at the very far corner in the top corner over here. So I hope that helps. Let's minimize that now. Get that out of the way. And there's a question at the bottom of the screen here. Let's bring that up and make that a little bigger so we can read it. The second question here was share more information about the asset allocation of your externally managed portfolio. Regarding the hedge funds, isn't it inefficient, expensive to have a fund allocate to hedge funds in terms of costs, as you have two layers of fees? Well, sometimes you can't access them directly, so you're going to need somebody that can help you access these, who's already done the due diligence on these funds. Because if there's a Bernie Madoff out there, it'll be in the hedge fund space. It's not going to be in equity, in the equity space. So if you send money to a small cap manager, it's doubtful that it would be there because there's usually a custodian in place, so that at any given time the shares being held are really held in your own name, even though it's a fund that's managing it. For hedge funds, that's not the case. They have their own funds, so money goes in to their own funds outside of a custodian. Now they may have a custodian, but it's not your custodian. So if there's going to be trouble, it's going to be in there. Well, how do you know, right? It's better to have somebody else pick it. And it's not really, the fees really aren't that bad. The bigger the size of your portfolio, the lower the fees that you're going to get. So overall, to get good external managers, if you have a significant size, is not really that expensive. So I don't really think about it that way. What type of strategies do these hedge funds follow? That's a good question. I really don't know what's in there. I just sort of made the decision on the on the top allocation. So 10% fixed income, 25% alternatives, and 65% equities, mostly international, and it's split between small cap and I believe large cap, and that was it. Beyond that, I don't really pick the strategy or the style. That's the whole point of having somebody do it. If I was going to pick everything, I'd do it myself, right? Let's see. I know you like to aim for cashless call spreads and risk reversals by entering the position in two stages. First buy the call, then depending on the direction of the market, you sell a put or you sell a call. I have been toying around with different type of cashless call spreads, exploiting the juicy yields on the 2-year note to finance 2-year call spreads on assets I am long-term bullish on. That is 8.4, okay, over 2 years, usually enough to finance a spread between a 2-year at-the-money long call and a 2-year 30% out-of-the-money short call. For a long-term trader, what is your analysis on this way of financing spreads versus what you usually do? Well, you're not really financing it, are you? I mean, you're not getting it cashless because you're taking your money and you're putting into an asset that has a return, 4.2%, and then you're using your return to finance a long call here and a short call over here. So whatever this cost is, you feel it's offset by this, but you're putting money to work and earning a return and then using that return to finance this. such that if you didn't do this, you'd have this return. What I do is I'll buy a call. It's going to have negative carry. And then I will look for positive carry somewhere else. So whatever my assets are doing over here, I don't need the cash flow off of this to finance this. I look for ways to get this all self-financed. So you're really paying for it. You're just paying for it out of your return as opposed to out of your capital. But in the absence of the options over here, you are giving up 4.2% return that you would have gotten anyways. So you are in fact paying for it. What you want to try to do is use the securities themselves to offset against each other, to offset the positive and the negative carry, to eliminate that part, number one, and to also get cashless using the very securities themselves, not by using the cash flow off of some other security. Because I could do the same thing. I could say, well, I'm in REITs, and every time I get a dividend, it finances these. But the dividend is my return. If I keep doing that over the course of the year, I would have zero return. So you are in effect paying for it still. Do you utilize share lending in any of your portfolios to pick up slightly higher yield on your longer term positions? Yeah, I have elected for it, and you can. There's a feature in IB. For stock lending where it will scan your portfolio and determine whether or not you qualify based on how long you tend to hold things. If you have high portfolio turnover, chances are you're not gonna qualify. And then it'll look at what you have and determine what are the highest yielding stocks. So this is a printout here. Highest income generating stocks lending are, and I have three little small cap REITs from Canada that they're not big on capital gains, but they've got dividends approaching 10, 11, 12% based on their price. So they're just nice income earners and a great place to park money because they have low volatility. But this is the estimated income on lending out your shares. Estimated income. Now, you can join a stock lending program, but if nobody borrows your shares, you don't make it. This is assuming that your shares would be borrowed, that whatever you have would be borrowed. You're talking about basis points, but if you're a long-term holder anyways, you say, well, I'm going to hold this for 5 or 10 years. What would you care? It's just extra incremental income. So there's about $1,500 US dollars close to about 2,000 Canadian incremental over the course of the year. If I said, yeah, go ahead, I don't care. And these little guys, they're low priced, but they've paid dividends for years and years. So I just hold them because they have nice cash flow. It's not a big investment in these, but yeah, you can get some extra incremental income if you want. Thoughts on the reason the initial jobless claims numbers not yet reflecting the increasing layoff announcements? If you are doing layoffs in the U.S., there is a law. There's a 60-day notice. I think it's 60 days. If you're doing something considered a mass layoff, is you must first give notice of the layoff. So when Microsoft says we're laying off 10,000 people, that's not going to happen till March, because you have to give a 60-day notice first, and then individuals who feel that, well, maybe the writing's on the wall for me, they have 60 days to find another job. So it's not as if everybody has to go home that day, unless, of course, the company is just done, and it's over, and there is no cash flow, and well, then off you go. But there's usually an announcement period. So all those layoff announcements have not resulted in terminations yet. But even if somebody, especially in IT, gets laid off today, they can usually find another job rather quickly. The auto companies basically put out a call to all the tech company employees that are being laid off, saying you can come over here, no problem. So I don't think any of those are going to hit the unemployment records unless they want to. Once an employee hears their company will participate in layoffs, I would assume the employee would get a head start on finding the next job as a form of risk management in case the other one is let go. That's exactly it. Have any other recessions in the past been partly Fed induced by rate rises? Yes, not partly, entirely. 1981. You had the Iranian Revolution in 1979, which caused a recession. Then inflation went up, and Volcker kept raising rates, saying only a recession can fix this. And you had what's called a double dip recession in 1981. That was entirely caused by the central bank. Entirely caused. When the Fed raises rates, it hits weaker companies sooner, and it hits weaker economies sooner, especially if central banks around the world in developed countries are raising rates. And sometimes, it's not the high rates that cause the economy to go into recession. It's the high rates that caused a number of significant bankruptcies that caused a freezing up of credit that then caused a recession. So when we think about the cause, there's proximate cause, or you think about how proximate the cause is. In 1981, it was the cause, period, is to beat inflation. Volcker was absolutely willing to put the economy into a recession. Kind of sounds like the guys we have now, right? That based on what they were saying, they're absolutely willing to put the economy in a recession to get inflation out of the system. I'm not sure if you already answered the question in previous videos, but when the reverse repo drops, is it due to market forces, money going elsewhere? Yep, that's all it is. Or central bank decision. No, it's not the central bank. They're not making any active decision to limit the funds at the reverse repo window. They almost can't, simply because when they set an interest rate, right now it's 4.25 to 4.5. That is a target range. The only way to keep that is with what's called open market operations. That's why it's called the FOMC, the Federal Open Market Committee. And they use open market operations to keep the interest rate in between 4.25 and 4.5 by telling the banking community, if you need to borrow money, don't pay 4.6%. We'll lend it to you at 4.5. This way here, no bank is motivated. The interbank rates would never get above 4.5 because you could always just go to the Fed window to get it. So it keeps the rate here. And if a bank needs to deposit money, they say never accept less than 4.25 because we'll give you 4.25. So the interbank rate would not get below 4.25 because if it were 4.2, a bank would say, I can simply go to the Fed and get 4.25 on my money. And it's these open market operations, repos and reverse repos, that allow the rate to stay between 4.25 and 4.5, because if it was too high, you'd borrow at 4.5. If it was too low, you'd lend at 4.25, in which case they basically make the market for anything outside of this range empty. Why would anyone ever engage in a market outside there when you can get those two rates? I'm hoping you can illuminate the difference between the federal funds rate and SOFR. When would SOFR not follow FFR? The federal funds rate is the central bank's target rate. It's not an investable rate really, because it's a target range, 4.25 to 4.5. So it is only certain market participants that could access the Fed window for repos and reverse repos to get the rate that the central bank would pay. But for the market as a whole, it's not an investable interest rate. So Fed funds futures usually target the middle point of the range. So let's say over the month of, we'll pick a month January was a good month because you had a December decision and you got a February 1st decision. So through the month of January, there were no decisions. So we know that the range is 4.25 to 4.5. So the Fed funds futures for January would have targeted the middle point of the range, and it would have been 100 minus 4.375, and it would have stayed there all month long. Being that we know that that's the target range and there is no central bank meeting during the month of January, it would be trading at that price. What's the point of trading it? Because you're asking how come there is not a lot of volume. So January would have been 95 point, what are we looking at here? 625? Yeah, 625. it would have been that all month long. So there was no point in going long or short that rate because you're not going to get that rate. It's just a federal funds rate, and it's not going to move. It's just not going to move. Now, when you go out to December, the curve looks like this. At December, it's implying that the rate is going to be 4.5%. Now you can start to say, well, if in June or July the rate's going to be 5%, the Fed's only going to cut rates if the economy is weak and going into recession. You think a recession is 2024, let's say, so you think, no, it'll be 5%. You would then short that particular contract, making a bet on the policy rate. SOFR is a secured overnight funding rate. This is an investable rate between banks. So if you can't go to the Fed funds window to get the to borrow at 4.5 or lend at 4.25, you can always, if you're a financial market participant that is in that interbank market, you can always get the one-day secured overnight funding rate. And that's it's a market-determined rate that usually is in between these. When would SOFR not follow FFR? It would be rare that it would not follow FFR very closely. I can't think of a condition under which SOFR would not follow FFR because it is secured. Before SOFR, there was LIBOR, which was the London Interbank London Interbank overnight rate. It was unsecured. So because it was unsecured, there was credit risk. And because there was credit risk, it didn't have to follow the Fed funds rate. But SOFR is a secured overnight funding rate, which means it's secured with treasuries. So even if the person you're lending money to or the entity you're lending money to has some perceived credit risk, the loan itself has no credit risk because it's secured with treasuries or T-bills. So because of that, it should follow FFR as FFR moves. Why is there so much more volume in SR3 futures than ZQ? Well, I just explained over here through the month of January, there would be no motivation to trade it because the futures would be at 95.625 and there's no reason for it to move at all. So there would be no volume in there. The SR3 is traded more than ZQ because it is a hedging instrument that you can hedge over periods of time. If you think you're getting money in May, let's say, and you're going to, let's say, put it in a 30-day security at that point in time, but you're worried about interest rates changing, you can trade the 3-month SOFR futures SOFR futures at that time, such as if interest rates drop, you make money, so that when you do put your money into a 30-day security at that point at a lower interest rate, you already got paid because the interest rate dropped, thereby locking in a higher rate. So because it's used as a hedging instrument, there's going to be a lot more volume in it because it is a tradable interest rate and an investable interest rate, but the Fed Fund futures isn't. How do we eventually come to know what sort of data we should be looking for? Experience and education. Well, I shouldn't say experience and education. There's a number of things. Education will help, but there is a very particular place for education. Most people think, well, you educate yourself first and then you go out into the market and then you look for things. That's not very efficient. And I can prove to you it's not efficient by getting you to do one little experiment. But education, experience, which experience is just a function of time, time and intensity. It's not a matter of, 4 years have passed, I've got more experience. Well, no, you don't. Not if you didn't do anything. I mean, if you just sat there and stared at your screen and you never learned from any mistakes, then nothing has happened but 4 years have passed. You haven't gotten any experience. So it's a function of time and the intensity of time. And then there is exploration, which means you read stuff. You gotta, when a company puts out its financial statements and its investor presentations, you gotta read that stuff. And you gotta read the reports from companies that you don't necessarily follow. you should, in all of the sectors of the economy, have at least 2 or 3 companies that you tend to follow and read their reports. Because what somebody says in the tech sector may matter for something you have in industrials, because they see trends and something happening that you say, well, that's important for my company over here, or for this company over here. So everything is sort of connected in a big mosaic, right? Here's where education comes in. We tend to think, well, you go to school, you learn something, then you go out into the real world and apply it. This doesn't work very well, and I'm kind of critical of this in a way, simply because I can teach you a whole bunch of stuff, but if it's not relevant to you right now, you're not going to remember it, and you're not really going to read it in the same way. So I can give you a paper, for example, and I can say, read this paper, and then I can ask you questions about it. Or I can ask you questions about it and then give you the paper to read. You will read it differently when you already have questions in your mind, because now you're searching for answers. But when you have no questions in your mind, you have no problems to solve, nothing on the page is an answer to anything you have, so you don't know what's important and what's not. So educate yourself, and your first round of education is familiarity. Get familiar with, what's out there. Go get some experience, and then come back to those very same readings and read them again, and watch what happens. Watch what comes off the page. So when we say, what sort of data should you be looking for? If you go back to level 1 macro, the readings in macro, there's one on business cycles, and there's one on monetary and fiscal policy. If you've been following the weekly outlooks for a number of weeks, go back and read these 2 and watch what jumps off the page at you. Watch how many things you read, you go, oh, I forgot that. Well, maybe you didn't forget it. It's just when you read it the first time, you thought, I don't know, is that important? Is it not important? I have no idea. But now you'll know whether it's important or not. So it's important to educate yourself, to get familiarity, get some experience, but come back to the education again and redo some of the things you've done and watch what jumps off the page for you. At the end of the video, you talked about your thinking process for valuation of any asset class. You begin with rates, you add some factors to arrive at your decision. Is it possible to pick a stock or an option? Well, an option is nothing more than a derivative on an underlying, so you better understand the underlying. An option is just a tool to trade the underlying. You wouldn't analyze an option, you'd analyze the underlying and determine whether or not you want to trade it using options. To pick a stock and do all the process from scratch? Yes, absolutely. That is what the CFA process is about. It has elements of bottom up, it has elements of top down. I think it will help me because I like the way you analyze the market, but I can't apply it to a specific asset. So do what I said up here. If you've been through level 1, you might want to go back and, especially for the bottom-up process, revisit FRA. And if you're at level 2, there's one whole reading in there on financial modeling. It's a long one. I think like 100 pages on financial modeling, which leads you step by step by step through a way to analyze a particular company. So you have been through that perhaps. And at the time you were going through it, maybe it wasn't relevant to you, so you didn't think, well, maybe this is important, maybe it's not. You tend to forget a lot of that stuff because it wasn't answering any question you had. Well, then come back to it. There are some cultures, and if you go way back to ancient Greece, I believe Plato, I think it was Plato or was it Socrates, I forget which one it was, had a rule that you had to be at least 30 before you attended their what they called gymnasium, which was a school. Before you attended their school, you had to be at least 30 because you have to come here with some life. You have to come here with some questions of life in your head. Otherwise, you're not going to get any of this. You're not truly going to appreciate the thoughts that we have and the thinking that we do unless you have some experience. This is sort of what is affecting higher education today, is that you get out of high school and you head straight for uni. Well, where are your questions? Where's your life? So more and more now, it is high school, to a certificate, maybe a 5 or 6 course certificate in something, and then you hit the real world. And then you revisit university later on after you have questions in your mind. And I do think the university model is in a lot of trouble. The 4-year degree, I think, is in a lot of trouble, because having been in that industry, I call it an industry, for basically my entire life, I can tell you right now, in about 15 minutes, I can turn that into a 3-year with no loss of quality. And with some thinking, I can turn that into a 2-year, still with no loss of quality. So the 4-year is just a pure waste of time. You can turn it into a 2-year. In fact, I think a 2-year is even still too much. I think a 5 or 6 course intensive program in the field that you want is good. Get out in the real world, get some experience, make some mistakes, come back, and when you come back, everything will be so much more relevant. So try that. Try revisiting a reading or a textbook that you had years ago, and watch as you go through it. You'll see things that you go, oh, it's written right here. I always had the answer to it. It's just, it never seemed important to me. I never paid attention to it, and I never remembered it, but it is sitting right here on the page. Do that. Another question of portfolio management. I shorted some February 17th Tesla naked calls that were deep out of the money. Total portfolio delta of these positions was something like -10. However, after the last trading days where Tesla increased more than 20%, all the naked short options were still out of the money, but my Tesla portfolio delta increased by almost -80, which gave me a terrible unrealized loss. My strategy was to continue with the same Tesla portfolio delta of -80, but increasing the number of contracts with lower deltas again, less than 0.16. I still believe in a correction of Tesla in the short run, and that is overvalued. I wonder if this could be a good way to manage the position, work my way out of trouble over time. Is there a better way out? What are the most important risks of this trade? That is a terrible idea to do. So just so that everybody understands what is, let me just move some of these other questions down so I have some room to write. There we go. So what we're doing here is, there's Tesla, and you've gone up here and you sold a call, and the delta was about 0.1. And of course, since you sold the call, you have negative delta. That's really far out of the money when you initially sell it, but then you had this run up. So now that you've got about 0.8, about negative 0.8. If you sell calls higher at, let's say, 0.16, you are actually adding more negative delta. So you're actually making your position worse. And I get what you're doing. You're adding more negative delta at that point because you think it's going to pull back, and that you don't need such a big pullback before you hit your break even, that these might pay off and help offset the loss over here. But it's the wrong direction. What's working against you right now, remember, these things have convexity, right? Options have convexity. So the higher this goes, your loss day by day gets bigger and bigger. On the same position will get worse and worse and worse because of this convexity. You need to put some negative convexity in there and get rid of that positive convexity. So you need to lower your delta at this point. And that can be done in a number of ways. If you've sold a call and it's going up, I would not sell 0.16 calls. I would go down and sell 0.16 puts. Puts have negative delta, so if you're selling negative delta, you add positive delta. So if you have negative 0.8 and you add 0.16 here, now you have negative 0.64. So right away you've lowered the pain of your losses. Negative 0.8 is the equivalent of being short 80 shares of Tesla. If you can do this and get down to negative 0.64, it's the equivalent of being short 64 shares, or in other words, you can get the same thing by simply buying 16 shares of Tesla. You just buy 16 shares and you can get your delta down. What you want to do is you want to get this delta down, not up. So I would be more apt to sell puts than calls. And you have to understand Tesla had a good quarter, defied expectations, is trading at, I think, a multiple that doesn't make any sense, because you had price cuts. They've gone from 30% margins, a little over 30% margins in Q1 of 21 to mid-20s by Q4 of 21. and their guidance was for margins greater than 20%. So they know they're going to be somewhere between 20 and 25. They will eventually get to 15 and eventually get to 10 because they are an auto company. They have no choice. It is the trend of the market. But right now you have momentum. And when you have momentum, you can play momentum. Momentum is your friend. So being that the market is willing to accept the soft landing scenario at this point, and being that Tesla just defies a respectable valuation because of the retail following of it, I would be more likely to sell the puts on this at 16 delta to lower my exposure. You want to get this close to zero if you can. So I'd be more willing to do that than anything else. I would not be adding to my negative delta at this point. I'd be looking to get that delta back to zero. And I think that's a big mistake that traders make is the averaging into positions. Once they have a position and it works against them, they think, well, if I just add a little bit more now, I don't need as big a correction in the price to break even. And they're trading against the trend at that point. So what you want to do is you can hold your position, but rather than when a position is not working out, rather than adding to it, what you want to do is you want to, if this is the zero line and it's working against you because your delta is going too high, you want to do something that gets it back to zero. Same with if you're losing and your delta is moving this way on you, you want to try to bring it back to zero. That is the point of using securities to hedge out and get out of trouble, is trying to continually rebalance back to zero until you work your way out of a problem. Thanks a lot about the recession signals and the market's reaction. How do you read this? Well, it's a good question. How do you read this? Because right now you can read it in a number of ways, right? It is consistent with what looks like a soft landing. But the pathway from a slowdown to a recession goes through a soft landing. Much like if you're in Windsor, Ontario, and you're driving to Ottawa, you go through Toronto. So if your passenger says, we're going to Toronto, aren't we? And you say, no, we're going to Ottawa. And you start driving, your passenger will say, we're going to Toronto. This is the way to Toronto. And as you get to Toronto, your passenger will say, told you, we're in Toronto. We're always in Toronto. I knew we were in Toronto. Well, you have to go through that neighborhood to get to Ottawa. You have to go through the neighborhood of the soft landing to get to a recession. So at this point, it's like, okay, is it going to be a soft landing and we take a left turn or a right turn and head this way? Or are we still going to stay on the highway and head into a recession? You can read the data two ways right now because we are in the soft landing neighborhood, but we're still on a highway going somewhere, right? So I read it that way, that there's a certain momentum in the leading indicators right now that simply just doesn't make a sharp right turn. Is the market really complacent or in fact confident that we can see through the upcoming downturn? It is split. You can have 5-10 analysts on Bloomberg in the morning and half of them will say, no, we see a recession coming up. This is, and they have good data to back it up. And others say we see a soft landing and they have data to back it up. So the data right now is saying this is a soft landing because we are in the soft landing neighborhood. The question is, are we driving towards the recession neighborhood or are we going to take a right turn and go up? Nobody knows yet. Don't have enough information yet. Let's see. If latter, would the argument against it, the potential recession would be short and shallow? Well, here's the thing. Nobody really knows anything about this, but I will say this. It is difficult to get a long, deep recession without a credit crisis, without some credit issue. Credit is not an issue right now. So if there is one, I tend to think it would be short and shallow. But you don't need a severe recession to have a severe bear market. The recession of 2001, 2002 wasn't that bad. But the market, the S&P dropped some 50, 60% top to bottom before it bottomed out. NASDAQ was even worse. So you don't need a deep recession to have a deep bear market. Even a shallow recession can affect earnings significantly. Using IBKR, do you sometimes get data not showing up in your My Portfolio tab? Yeah, you get these little dot, dot, dot. So I have Oxy, OXY, long positions in Oxy in buy rights. So 67.50 buy rights, 65 buy rights, and I get these sometimes on that one. It's kind of frustrating, but I can do the math myself because I have the numbers in the other columns, so I could just multiply the three columns to fill in the ones that missing. But I do get that from time to time. It is a little annoying. I don't know of a way to fix it. What do you think is happening in the high yield market? Right off the top, it's we haven't seen yields at these levels for such a long time that for many credit investors, it's like, oh, look at the yield I'm getting. Let's grab that. Is it just that these bonds are so beat down from interest rates and equity volatility last year, they're still undervalued? You can make arguments like that for equities because there is no consensus on what the cash flows for equities are, but there's consensus on what the cash flows and the timing of those cash flows are for bonds. They're known in advance. And the term structure of rates are known in advance. So you can arrive at a present value of that particular bond that everybody would arrive at if they knew the timing and the size of the cash flows, and if they knew the term structure of rates. They could arrive at the price of the bond. Now, they may have different estimates on what the credit spread should be, but typically how we get the credit spread is we know the price of the bond in the market. We know the term structure of rates. We just have to solve for the spread that allows us to recover the price we see in the market. So the question is the spread compensating you for the risk? Right now, spreads are really, really low. So you're not getting paid a really attractive amount to take on credit risk in the high yield market. There's the question is, are you being paid enough or are you being underpaid for the amount of credit risk? Balance sheets are strong, as you say here. Probability of loss, saying here, has been elevated. It hasn't been elevated. Probability of loss seems rather, I don't think it's been elevated. I don't think it's higher than any historical value that was in there. But that balance sheets are strong, and the thinking is, well, we don't really see a recession. We haven't seen waves of bankruptcies and defaults at this point in time, so everything seems business as usual. Where credit spreads usually widen very quickly is when there's a significant credit event in the market that was unexpected. So if a significant fund comes out and says we can't, our credit lines were cut, or we can't get, we have to lower our leverage, we can't roll over our debt, or whatever the case is, that would be a problem. If a company that you didn't expect had credit issues says we can't seem to roll over our debt, we can't find any place to roll over, that would become a problem. Or if you just had a bankruptcy, again, that no one expected, all lenders would pull back and go, whoa, 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 we didn't see that coming. What else is out there that we don't know about? I mean, we can't see the sharks in the water. Let's everybody get out of the water. And if credit dries up, spreads widen very, very fast. But it's hard to see spreads really widening until credit becomes an issue. And right now, credit is not an issue. And balance sheets are strong at this point in time. So it's probably reflecting that condition. I wouldn't say that high yield is undervalued. I would say that the spread just does not seem to be wide enough to compensate you for the credit risk that you would be accepting. Now, once you get to that conclusion and you believe that credit spreads aren't wide enough, then you have to then go to equity and say the discount rate on equity must be too low if spreads are too narrow. So that equities must then be overvalued as well. Any comment on 0 days to expiration options? I cited an article stating 40% of option trading is for these sort of dated contracts. Any comments on how they affect the VIX? VIX is, it did fall outside of the VIX because I believe VIX is anywhere from 17 to 38 days. So anything less than 17 days is ignored because they try to target 30 days. So it's you have an option here and an option here, and once you get to within 17 days here, then it jumps to the next one. So it's like 17 to 38 days. So 0 DTEs wouldn't be included in the calculation of volatility. And because it is a forecast for the next 30 days, 0 simply doesn't have any days, right? My assumption would be that they may reduce VIX artificially, given VIX based on monthly expiration. No, VIX is for today is an assessment of what volatility is going to be over the next 30 days. And the options must be, I believe it's 17 to 38, at least 17 days to expiration, but no more than 38 days to expiration. And they use that range. So they don't even get into the VIX. 0 days to expiration really is just a bet. You cannot make an argument that somebody's hedging with it. But the payoffs can be very, very big, but you need very particular things. You need high volatility, and you need the belief that there's going to be a big move in the stock during the course of the day. So let's take SPY, for example, and let's say it's Friday and the market's just been going up all week, but the data's been, and it's been going up. Earnings are, not really that great. Suddenly we're trading at 19 times forward earnings, and you think, come on, like, where are we going? Well, you get to 3 p.m. and it's very common, especially going to a Friday when you've had a good run, that there's a sell-off into the close. So at 3, you may buy an ATM put. Well, with 1 hour to expiration, the put is worthless at 4 o'clock. With 1 hour to expiration, you might be paying, 50 to 60 bucks for the option contract, 50 to 60 cents. And if you get a 30 to 40 point sell-off in the last hour, that translates to $3 to $4 on SPY. If you pay 50 cents for a $3 move, 50 bucks pays 300. But there's very little difference between that and betting on a sports game or going to the track and betting on a horse. There's very little difference between that. You're not hedging in the last hour. So it is really just gambling. And it is a big casino. If you want to treat it like a casino, it is a very big, very lucrative casino. In this week's Bloomberg Wall Street Weekly show, RBC US equity head and Goldman Sachs CIO are saying investors are switching to risk-off mode because they priced in too much risk for their earnings. From that presentative, I would like to know what's your thoughts on that. Yeah, I think so. I think there is, this is what markets do. They oscillate between, over optimism and over pessimism. I think a fair range on the market right now is somewhere between 38 and 4,000. And probably if I had to be pushed to it, I'd say 38.50 to 39.50. In there is probably, what I would say where we are today and what we know today is probably the right range to be until data starts to prove it otherwise. And some people are thinking, but data is proving it otherwise. Inflation is coming down. The Fed is going to pivot. They're going to pivot. I don't know how many times I've heard that in the last couple of days, the word pivot. The Fed's going to pivot this week. No, they're not. They're going to raise rates. They're going to raise rates. And even if they don't raise rates anymore, going sideways is not a pivot. It's a pause. A pivot is you're going in one direction and then you just move into a completely different direction. Okay? So for those of you who are overusing the word pivot, pivot means a completely different direction. It does not mean a continuation of what you're doing. So I think this is the right range here. Once you start getting to 4,100 and you see earnings forecasts dropping week after week, $1.20, $1.30 every single week, you look at the forward earnings and they just keep dropping, and the market keeps going up, meaning the multiple gets higher and higher. It's just hard to see where all that optimism is coming from. But there are funds that have benchmarks. Lots of funds have benchmarks, and they have to beat the benchmark. So if the market is moving up, they have no choice. If the music is playing, they have to dance. Even if they disagree with it, They have to dance. They have to get on board with that rally, even if they don't like it. They've got to do it. So some of the rally ends up becoming, you know, I wouldn't say self-fulfilling, but develops its own momentum simply because funds that have a relative benchmark do have to attempt to beat the benchmark. And if the market is rallying, you got to reach for beta, which means you've got to lean into these things. Next one is a comment. When I write lines on TradingView, I put the date so it is relevant by the time I come back to the chart. Yeah, I can see that point. So the S&P was doing this, right? And you had this long downtrend that had been in place for a very long time, and it's since breaking up. Well, usually you just draw another downtrend channel, but the thinking among technical analysts is that the longer a trend line has been in place, the more significant is the break above it when it does happen. So that if you draw a trend line and 5 days later it breaks, you draw the trend line and 5 days later it breaks, those aren't significant breaks. But one that's been in place for months and months that's broken is significant. Yeah, okay, so I'll give a point to that. I hope you're doing well. I want to ask you where I could find the OAS spreads and GDP breakdown. You can get the OAS right from Fred. So just type in high yield OAS Fred into Google and the first link. And you can change this, and you could say BB, you could say triple B, you could say IG, and Fred will give it to you without a problem. The GDP breakdown, that is the BEA. BEA.gov has the PDF for GDP. After this screen, I'll show you where the breakdown is in terms of contribution to GDP. Do you think that due to recession, there are coming 2 cuts of rates like the market is pricing in? That's why equity markets have higher multiple? No, I don't think, no. What time horizon are you using for the volatility of GDP? Usually it's over a longer period of time. You'd want at least 30 observations for it. I don't calculate the volatility of GDP. These are different values that you could usually find in academic papers on that deal with GDP. The volatility tends to be fairly stable over a long period of time, so you can find different estimates of volatility. They're all within the same neighborhood. And if you need 30 observations and you have quarterly GDP, you can see that you'll need at least 7.5 years to get that done. Where did you take the futures curve? I think you're talking about the Fed funds futures curve. That's from the CME. Just type into Google STIR Analytics CME, and it will give you the link for that. STIR is short-term interest rates. I saw a story on Bloomberg that said the U.S. corporate defined benefit plans are sitting on their biggest surplus. Surplus is just, if you look at the present value of the assets, or more commonly the market value of the assets minus the present value of the liabilities. If it's greater than 0, that is a surplus, or at least we'll call it a surplus. A surplus could be a negative amount. The surplus is really just the difference between the assets and liabilities, but they are referring to greater than 0 in this case. How did they manage to do that given the substantial rise in interest rates? That is exactly how they did it, the substantial rise in interest rates, because you got to get to the present value of a liability, right? So you have some future liability, and it's usually discounted at a high quality corporate bond rate, an investment grade rate, and you discount it and you'll get what's called the present value of the liability, and then you compare that to the market value of the assets you have. Well, the higher the interest rate as you discount back, the lower the present value of the liability is. So it's not so much that the assets have really increased as much as the present value of the liability has really decreased. However, here is the thing that you have to remember with this. The higher the discount rate that you have, the lower the present value, but the higher the interest rate factor year over year. Because now the liabilities have to grow at, instead of growing at 4%, the liabilities now have to grow at maybe 7%. So now your assets have a higher hurdle rate to perform. And the interest rate factor that gets added on to the liability each year just with the passage of time is now a higher number. So sure, it creates a big surplus today, but on a going forward basis, you have this big interest rate hurdle amount that finds its way onto the income statement. So companies with defined benefit pension plans going forward, when we look at the service cost component of the liability, it's going to have a much higher interest rate factor associated with it. Unless rates come down and you then get to use a lower discount rate, you'll have a lower interest service cost component, but your liability will rise very quickly and this surplus will disappear. Okay, for GDP, you're going to get the GDP report from BEA.gov. Go to Table 2, Contributions to Percent Change in Real GDP. Your very first line here, line 1, Gross Domestic Product. There it is, 2022. There's Q4 at the very end, 2.9%. Then you have percentage points at annual rates. The first line, and you can see with all the indents where they belong, right? There's your personal consumption expenditure is 1.42. So of the 2.9, we've already got 1.42. This 1.42 breaks down into goods. You see the bold line for goods, and down here for services. So goods is 0.26, services is 1.16. If you add the 1.16 and the 0.26, you get to 1.42. There's consumption. The next line here is gross private domestic investment is 0.27. We can see that it's made up of fixed investment of negative 1.2. And there's change in private inventories of 1.46. So if you add those two together, you'll get to 0.27. And you just look at the at where the line is. The one closest to the margin here, there is C. Scroll down, there's the next one. There is I, gross private domestic investment. Here is X minus M, net exports of goods and services. There's 0.56. And then the next one is G, and G is 0.64. And in net exports of goods and services, it's breaking down into exports and imports. You could just read across for exports, and you can see that was negative 0.15. Imports was 0.71. Since they're the, on the tree on the way down, since they're the next layer, the line item for exports and imports should add up to the line above it. So under exports, you see goods and services. Well, these two numbers should add up to the line above it. And then, of course, exports and imports should add up to the line above that. And that is in Table 2. There were a number of questions of how I got the numbers that I got, the contributions towards GDP. It is from Table 2. Table 1 is the percentage change in each of the components, but it's not the contribution to the GDP. If GDP was 2.9%, where did we get that 2.9% from? Well, 1.42% of the 2.9 of GDP came from consumption, etc., etc. So Table 2 is where I get that number from, or those numbers from. I saw a video on YouTube talking about how several of Michael Burry's forecasts on the U.S. economy were right when the market was saying otherwise. If the market was indeed betting in the opposite direction, doesn't that mean major investment banks and investment funds were wrong? It's hard to pull that apart. I'll come back to that. What I find puzzling is that those financial institutions are supposed to have the best talents and investors, so it would seem to me Michael Burry can't be the only one to have somewhat accurate economic forecast, and surely the analysts and investors in top financial institutions see the same thing. Could it be possible the financial institutions can be restrained by their investment mandates to place the correct bet? In some degree, yes. So there is a difference between if you say, is the market going to go down this year before it goes up? I believe that to be true. So I can position for the market going down. However, somebody in a more critical position that's managing client money says it's not enough to say the market is going down before it's going up. What we have to determine is this rally going to last a little bit while longer? They may agree that the market is going to go down before the market goes up, but they may disagree on when to make the bet that the market's going to go down, because they may say this rally will last a little bit longer, and then we think the market will go down. But if we miss this move, well, that's a bit of a problem. All of these little moves that we miss are a problem. So it just could be the difference between the time frame at which they're looking at. It also could be the mandate. You could tell me the market's going down, and I could say you're absolutely right. Why am I still long? Because my benchmark is the S&P 500, and I just have to beat my benchmark. I don't have to make money. I just have to do better than what my benchmark could do. So that doesn't mean that I'm going to short the market or sell. The market is primarily long, not primarily, predominantly long. Short positions for a lot of funds are outside of their IPS. They simply can't do it. For other institutions and some funds, short positions are just not part of their strategic mandate, where they might say, sure, we could be short, but it's not something we do. So it's not as embraced as long positions are. Why do you have fund managers running some of your investments? After fees, they will likely underperform. Well, that's the point, right? You want to make sure that after fees, they do not underperform. So you look at their track record. You have to vet the fund managers. You have to say, do you have a 3-year, 5-year, 10-year track record? Let me see your performance versus various benchmarks. Hedge funds have a benchmark of the risk-free rate plus some basis points. Why do I do this? Because you have to diversify from strategies. I have a particular strategy that I like to use. You can't have all of your money doing the same thing or following the same strategy. You do have to be diversified. Plus, the money that I've given these fund managers, I don't consider my money. It's my money, but I don't consider it mine. I do have a will, and in my will, this money here is going to a university to fund a research chair in finance. So because it's doing that, I'm a caretaker. I'm not really the owner of the money. So, give it to some responsible external managers that have maximum diversification, sort of middle kind of risk profile that you want, as opposed to me with huge active positions. And I don't know that I have significant risk, but I'm willing to take risks that external managers won't take. So it's just to diversify away from a particular strategy. If the volatility of investment as a component of GDP is high, does that essentially mean there's more margin for error when we look at the data point? In other words, is there more measurement error in it? I don't know that I'd say that there'd be more measurement error in it because of its higher volatility. It may very well be that there is a correlation between the size of the measurement error and the volatility. The reason we would pay attention to it is since it is the most volatile, it will turn down first. It will be the one that, if we're worried about a slowdown or a recession, we look to that component because it will cycle more than the rest of the other components. How much of the recent weakening U.S. dollar impacts the trade balance? Could the increase of imports and decrease of exports mainly be affected by the U.S. dollar? I wouldn't say mainly, but to say that the U.S. dollar has no impact would be incorrect. It will have an impact. It's just that on the flow of goods and services, those are usually based on long-term contracts that have been in place for a while. So I don't know that the U.S. dollar really affects the majority of it, but at the margin, yeah, it probably would affect some trade, but it's usually a very slow adjustment channel. You mentioned that ice age will remain prevalent for longer than we want, as we're in a structural deficit to produce as much metals required to produce electric batteries. Would you say that oil and gas will prevail longer than we expect? That is a big yes. I wouldn't say longer than we expect. I think they'll prevail longer than the green movement would like. I think that there are a lot of people out there who expect it to last longer than what the green movement would like. But the green movement would like to see it gone in 5 years or 10 years. That can happen with major investment and significant increases in energy prices and a massive reduction in energy security. If you're willing to accept that, take your electricity bill or your utility bills and triple them, and every so often expect that you'll have brownouts or blackouts for a while because there just won't be enough electricity. And if you're okay with that over a 10 or 15 year period while more and more stable capacity is built, then let's do it. But for the level of the country as a whole, energy security is a big thing. And you're seeing that some places that were scheduled for green investment have been abandoned simply because it's just not going to solve the immediate problem we have, which is energy security in some regions, right? So to say that longer than we expect, I expect it to be longer than what the green movement would like. I think that's a better way to say it. With major U.S. oil companies resisting growth in CapEx despite significant cash balances and opting for capital returns to investors via buybacks and special dividends, what I understand is that capacity would only grow at a modest pace in the coming years, despite the fact that oil and gas account for 55% of the energy consumed globally as of 2021. Yeah, you're right, is when you have governments around the world holding a knife to the throat of oil companies saying, we are going to murder you. The moment we can, we're going to slit your throat. Don't you move. Why would you ever say, hey, let us help you out by lowering your energy costs by spending our shareholder money on new production that will never pay off? Yeah, let's do that for you. That's not going to happen. That's not going to happen. I think that's where liberals go wrong in their thinking, is they think that they can take from people and people will continually give. No, as soon as you start taking, my motivation to produce more to give you diminishes dramatically. That's a big problem. It's like an example that I always use when explaining situations like this. The green movement would like to see traditional energy companies go away. But you need a transition period to get that done. So think about it this way. Maybe your neighbor is an asshole. But if you need your neighbor to cooperate with you on something, maybe not start with, hey, asshole, right? And sort of that's what the green movement is doing. And I think that's what this new progressive liberal movement does, is it says, hey, listen, we have an idea of how we can all get along. But in getting there, they feel that it's appropriate to call everybody names first and then demand that they get along with you. That's just not how you get your neighbor to help you build a new fence. You don't start with, hey, asshole, we got to build a new fence. You want to split the cost with me? What do you think the answer is going to be, right? Also, wouldn't a slowing economic environment with higher rates deter green investment as money now favors certainty over uncertainty? Yeah, it's going to go for security relative to the stable growth, low interest rate environment decade past. Yeah, and what is going to be the consequence of all this is that energy prices going forward are just going to go up. Thank you for these excellent videos and for answering our question. This morning, Alarian indicated the Fed won't increase rates further than what's implied by market pricing, saying this leaves no wiggle room on the size of the hike for the Fed, even if it wanted it. Why should that be the case? I know it would be a surprise, but does it really put the Fed in a tough spot? Yeah, I think it does, because the data is indicating that the rate hikes so far, based on the limited data that we have, there have been a couple of months in a row where it's looking like, hey, this might be working. But it's not the time to cut rates just because you see it working. But it may be time to say, 50 may be the wrong move here because we haven't let the cumulative effect take hold yet. If we go 25, it allows us to continue to move in 25. But if we go 50, maybe we don't have that much more increases to go. I don't know. So 25 retains a lot of flexibility when you can start moving in increments. Financial conditions are loose right now by almost every measure. Looking at different measures of financial conditions, whether it be Goldman Sachs or Chicago Fed, financial conditions are the loosest they've been since, going back to last February. Before the Fed started raising rates, based on where we are in economic conditions, we still have extremely loose financial conditions. The Fed doesn't want that. Going 50 would send a message, but it's a dangerous message to send because you're actually using a tool to get that done. If you go 25, you can use your mouth to get the rest of the done. So go 25 at the meeting and go hard in the press conference, and to push that market back, and to put a little bit of fear into the market that you think If even if conditions deteriorate, we're not budging. So you better start pricing in these deteriorating conditions. And if you start pricing them in, then financial conditions will tighten. I think that's probably the safest way to go. Anyways, it's 1:34. The Fed meeting is in 26 minutes, so I was able to get this into the video before the Fed meeting. I won't be posting this till after the Fed meeting because it just takes time to get done. So I want to be clear that I'm saying this before all of this happens, just to see what happens. Okay, last set of questions here. First one at the top, is it possible that the yield curve inversion is due to a greater than usual number of folks retiring and moving their assets into short-term fixed income securities? If they were moving their assets into short-term fixed income securities, the front end of the curve yields would drop because prices would rise. So you wouldn't have an inverted yield curve, you'd have rates dropping at the front end. Also, this usually doesn't happen all at one time. It's not as if someone gets to 65 and then they say, okay, now I'm all in fixed income. There's usually a glide path to 65 where, at 35, you're 70% equities, 30% bonds. And as you get closer to retirement, you might be 60%, then 40%, then 50 and 50, then 40% equities, 60% bonds. So you glide towards it over time. It's not as if, oh, I retired, let me flip all the way into bonds. It usually happens gradually over time. So no, I don't know that I would put a lot of weight on that. Next question is here. I got a question related to the adjusted National Financial Conditions Index and the Fed funds rate. If we look at the 75 to 82 time period, we can see financial conditions were tight. Yes, they were. Greater than zero from 78 to 82. Effective funds rate greater than 7% during this period. Yet SPX rallied 50% between April 78 and the end of 1980. Well, mostly because of inflation, right? Inflation is going up. You don't need a lot of quantity. Your revenues are going up. Also, inflation is a nominal thing. Well, stock prices are nominal, so they would go up. You'd have to look at the returns in real terms, not in nominal terms, and the index itself is nominal. So if you had inflation running at 20%, it would not be surprising to see stock prices going up by 20, 25% every year. You would have to look at what is the real return that you're getting. Now the index shows looser financial conditions, and the terminal rate is expected to be less than 7%. There's a bull case that this shows that the equity market has room to run. Well, you're making a comparison between things that are not comparable. And that is sort of one of the criticisms I have with saying, well, if you look back at the post-World War II period, you had inflation because of supply constraints. It looks like what we have now. No, if you look back at the 70s, it's what we have, and the market did this, so we should expect it to do this now. And all of these comparisons doesn't really work that way. So rather than thinking about the market as a linear thing, and what I'm going to do is I'm just going to remove this stuff up here so that I can write some things up here. Let's see. I have different layers, so you got to delete each layer. In university, we think about equilibrium economics, right? There's your demand, there's your supply, there's our output, and there is our price level. And this is your GDP, and there's your price level. And if we get an increase in demand, basically the price level goes up. And output would go to this point until supply can respond to bring the market back into equilibrium by supply expanding because prices have gone up. Now we have greater output in the economy, and we've returned to this price level. We think that we could just do that. That if we expand in one direction, if we simply reverse everything, we would just go back to where we were before we started. That is not how an economy works. You have to think about, and I'll give you two examples here, and I've given this example in the applied series. Let's take a swimming pool, and you're filling the swimming pool with water. Well, the level is going to rise in the swimming pool, right? Well, if you start draining the water, the level goes back down. The economy is not a swimming pool. It's not something you fill with water and empty with water and say, well, okay, we were here at this level. We added some water to get to this level. So if we remove the water, the economy will just go back to this level. So a good way of thinking about it is we injected a lot of liquidity into the economy through quantitative easing, through fiscal policy. The balance sheet got expanded. And that if we just withdraw it, we will simply go back to the economy we had before all that happened. That's not how that works. You have to think of the economy as a swimming pool with goldfish in it. And let me tell you something about goldfish here. Goldfish are very particular types of fish. They grow to the size of their environment. I think a lot of reptiles do that. Alligators are like that. If you keep an alligator in a small aquarium, that alligator will stay small. If you let it run around your house, that alligator is going to grow. So at low levels of water, you have small goldfish. Raise the water level, the goldfish get bigger. Raise the water level, the goldfish get bigger. Raise the water level, the goldfish get bigger. You want to see a 50-pound goldfish? Drop some goldfish into a lake. They will grow to the size of their environment. So now you have big goldfish in the swimming pool. Now start taking out water. The goldfish don't shrink. They just die. You see what I mean? So when we think about the economy as just some pool that we fill with water and we can empty with water, forgets the fact that within that water live organizations. And organizations will grow to the size of their environment. And when you shrink the environment, they don't shrink back down. They simply have to adapt to a smaller environment at their size. These goldfish, once they get bigger, you take that 50-pound goldfish out of the lake and you bring it home and you stick it in that little aquarium. That goldfish will not shrink. It will just die. So an economy in 1978 to 1982 is a very different pool with very different goldfish than 2022 to 2023. So you cannot just say, but this should look like this. It's a different thing. So going from one equilibrium to another equilibrium creates a completely different economy that if you move back to the previous equilibrium is not the same thing as reversing what you did. It is moving to another distinctly different equilibrium altogether. So that's why it's difficult to compare periods from one to the other based on, well, these three variables were like this and these three variables here are somewhat different. Shouldn't the fourth variable do what the fourth variable here did? Doesn't work that way when you have what are called complex adaptive systems. And an economy is a complex adaptive system. It is not a linear system with equilibriums that are simply just more of what the other one was, and then we can move back to the previous equilibrium. Doesn't work that way. Here we are. What are your thoughts on the Fed having a tricky time politically when likely the headline CPI hits 2 to 3% in May or June? I understand sticky versus non-sticky, and they can point to the core PC services, excluding shelter and other components, but headline is what the public, press, politicians really care about and gets most reported on. They will have a job convincing the public, politicians inflation is rife with headline CPI at 2 to 3%. Well, the question is it? Is it going to hit 2 to 3%? So why is headline inflation going down so much right now? Because goods inflation has deflation going on. You have deflation in goods and you have inflation in services. So when you combine the two, it makes it look like inflation is rather benign. For it to stay at 2 to 3%, you have to believe that goods will continue to deflate, that they'll continue on their downward trajectory. This will not get worse. You have to think that, can you still get another round of deflation out of goods? Goods prices went up and then they came down, and usually they do this. So whenever you're looking at any complex adaptive system, and complexity theory will help you out here a lot. One of the common types of patterns you find all the time, why can't I get rid of my writing here? One of the complex patterns you find all the time, if this is sort of a self-regulating level within a complex system, and you have a growth of something that looks like this, when that growth crashes, it tends to do this. before it finds its self-regulating level again. So a good example of this is rabbits. When you have a population of rabbits that grow too big, they grow too big for the environment, disease and hunger starts happening, and then you get rapid deaths that shoot past, and then you get something that looks like this. And it takes a couple of generations before you're back at that level. So you had goods inflation, and now you have deflation, and then there's usually a rebound in something like this, because once companies clear out their old inventory by cutting prices, well, then they don't cut prices anymore. They go back to the normal prices. So in the last couple of months, you've seen goods prices drop and create deflation, which helps to offset the services inflation. But what happens when this rebounds and services inflation just stays at, like, let's say 4%, but this starts to rebound? The month over month, what's the month over month going to look like, right? Well, the month over month would be this way. The month over month would start to see inflation showing up in goods. So we're on this part right now, but this part is coming, because you can't keep going in one direction month after month after month. Goods prices are not going to drop for the next 10 months. They're just not going to do it. So at some point, the base effect is going to wear off, and you're going to start to see goods inflation showing up. So be prepared for that. So is it going to hit 2 to 3% in May or June? That's a big deal, is it? I don't know. Let's see. Evidence of 2 to 3% CPI forecast, July to December 22, 6 months annualized CPI running at 1.8%. Again, because you're taking a amount of deflation along with inflation and putting it together. If you go to the Atlanta Fed and you just look at the sticky component of core PCE, it's 5.8. And look at the 1 month and the 3 month annualized, you're still at 5.7, 5.8%. Let's see, even if we average the highest values, okay, no matter how you slice it, you're including this effect on one side of the inflation. This is coming. So it would not be surprising to see an increase in goods inflation in the coming months, only because all the prices that could have been cut have been cut, right? And we will leave it here for the week.